So allow me to take this opportunity to welcome you to our today's session. Today, we just need to look at a topic called portfolio theory, right? A portfolio theory. Now, this is just an introductory topic at your level. This topic is mostly tested at advanced level, where we are going to be doing a lot of analysis. And what we normally do at your level is just to do an introductory and having a better know-how of how the questions are basically tested and how you're supposed to be tackling them. Now, I know very well that in the room, we have some investors. We have some investors there who already have diversified the risk, because when you're discussing about a portfolio, we are looking on how do the investors normally diversify the risk, which is basically involved in the investments which we want to undertake. So basically, the most important aspect and is how you can be able to learn is that we remember that if, for example, we have three different types of investors. We normally talk about the optimistic. These are the risk takers. We normally have pessimistic, and then we normally have risk neutral, the neutral investors. And in this case, when you look at it, it normally explains or elaborates on the type of investors which you normally have when you want to take certain investments. Now, there are those people who like to take the risk. And that is why we are talking about risk takers. There are those people who are 50-50. They want just to take it, or they want to invest on investments which are not going to be exposing their initial capital to a certain level of risk. Now, so it means that when you're going to be discussing about the portfolio risk, portfolio theory, we are going basically to be discussing more of portfolio risk. And when you look at it, is a portfolio risk is going to be giving us a good leeway of what we are supposed to be doing on this topic. Now, when you look at it, as I have already discussed about the investors in the house, you have to be understanding that there are those people who are keeping their, for example, investments in the banks. There are those who like to do with money markets and circles. There are those people who even they don't want their money to stay in any financial institution. They just want to do a home banking, right? And in that case, it means that there is an aspect of getting certain returns for those who want to undertake a certain level of risk. So someone might invest in a given investment, for example, MMF, which is going to be giving you a certain proportion of a return and as a certain period of time. So it means that when I'm going to be investing, whether you invest on bonds, whether you invest on specific securities, you have to give them time so that they can be able to the capital of yours can be traded and give you returns at a given period of time. So that is where we normally look at the valuation concept in finance. We used to discuss about an investment which is already done on a specific security, but you have to be giving it, you have to give it time. Now, that being said and done, it means that if, for example, I'm going to be having three different of investments, what will be the expected return of the portfolio which I'm going to be making? And that is the aspect which we are going to be looking at it here. For the people who are doing more than one investment, how are you going to be getting the return? So it means that when we are dealing with the portfolio theory, what we are supposed to be knowing here, this is a combination. This is a combination. It is a combination of assets. Let me talk about of assets, stock securities. It is a combination of assets or stock securities with an objective. With an objective to, number one of the key objectives here, we can be able to talk about, number one, we can talk about maximize the returns. We can be able to maximize the return. Number two, We can also try to minimize the risk. We can minimize the risk. We can be able to minimize our risk as a type of investment. So in this case, when we're discussing about a portfolio return, when I'm discussing about a portfolio return, it means it is a weighted. It is a weighted average of return. Average of return, right? Average of return of assets in a portfolio. So in simple terms, when we are dealing with when we are looking on the portfolio, we are looking on the investments which are going to be investments or investors who have invested in more than two or in more than one type of investment. So e.g., we can be able to discuss about a portfolio. It is a portfolio made up of two assets. It is normally made up of two assets, e.g., right? That is, let me to use the word that is, asset A and B, right? So in this case, it means if I need to get the return of a portfolio, right? If I need to get the return of a portfolio, it means I'm going to be taking the weight of asset A plus, we multiply by a return of A plus the weight of B, we multiply by a return of B, right? Now, this is the return of portfolio. These are weights. Those are normally called weights, and these are the returns, right? Sometimes we might be talking about the expected the return. So in this case, when you're looking at it in this manner, sometimes an examiner will be asking you a very simple question, right? How can you be able to get the expected return of a portfolio? How can I be able to get the expected return of a portfolio? How do we normally get the expected return of a portfolio? Do we say to get the expected return of a portfolio, it's normally written like that. The expected return of a portfolio, it means we have to be taking the weight of A, asset A. We multiply by the expected return of A plus weight of B. We multiply by the expected return of B. This is normally called the expected return. I think the others are already defined. Now, in this case, sometimes you might be wondering, how am I going to be getting the expected return of a certain asset? And I say, to get the expected return of a certain asset, you just need to take the summation of a certain return, for example, return A, we multiply by the probabilities. We multiply by the probabilities because when we are discussing more about the risk, it means a probability has to be involved. For example, the people who were watching football yesterday, right? You could be able to have some probabilities, and that is why you normally bet. Nasema Man U will win, or the Liverpool will be able to win. What is the probability of them winning? You can be able to see one, for example, they are putting some certain odds there. Now, when it comes to the aspect of looking on the risk or analyzing the risk, we have to be basing our arguments on the probabilities. Now, if the probabilities are not available, it means it doesn't mean that you cannot be able to analyze your expected returns, but we say if there is an absence or probabilities, we normally use the sample sizes. We normally use the sample sizes. So to get the expected return, for example, of A, when the sample size is less than 30, right? Let me talk about when the sample size is less than 30, it means I'm going to be taking the summation of a return A. We divide by n minus 1. This normally applies when the sample size is less than 30. When the sample size is less than 30. That is how we normally get the expected return. This is the expected return. This is a summation, right? Now, what normally happens, right? What normally happens when the sample size is greater than 30? So it means to get the expected return of A, it means I have to be taking the summation of A, then I divide by N, right? And this is applicable when the sample size is greater than 30. When the sample size is greater than 30. That is how we normally analyze. It means that when the probabilities are not available, the question is wrongly set. No, the question is not wrongly set. It means that you have, it means that we have to be analyzing the sample sizes the question is being examined. Now, the other thing that you need to be checking here, right? We talk about, we say that the portfolio risk is normally measured by standard deviation and coefficient of variation. For those people who are coming from the classes of statistics, we used to say, to get the standard deviation, for example, we used to use the root of variance. We normally use the root of variance to get the standard deviation. Now, in this case, it means that this is the sign for the standard deviation, by the way. Right? That is the sign for the standard deviation. So if we need to get the standard deviation, we have to be taking the root of variance. Sometimes we might be asking ourselves, how do we normally get, just 1 minute, please. Right. Sorry for that. Now, I was discussing about the aspects of measuring our portfolio risk, and I said, to measure your portfolio risk here, right? To measure our portfolio risk, we are just going to be using the standard deviation or the coefficient of variation. And these are some of the questions in which the examiner is going to be asking to calculate the standard deviation of certain securities or the correlation coefficient or specific. Now, in this case, it means if I want to get the standard deviation of our portfolio, right? And I just want you to be very keen here. To get the standard deviation of our portfolio, it means we are going to be taking the weights of security A. And I have not said that the security has to be A or B, right? They might be bringing X and Y, G and H, M and N, and so on. So it means, I'm just using an example of NP. So the weight of A squared, we multiply by the variance of A plus the weight of B squared, multiplied by the variance of B. We add the two, weight of A, weight of B. We multiply by the covariance of A and B. We multiply by the covariance of A and B, right? I just be able to define everything there. Just want to make sure that you are able to see everything and make it clear for you, right? Okay. So this one I have said they are normally called weights. Those are normally called weights, right? These ones are variances, right? Then it means if I have the standard deviation of a certain asset, sorry. Sorry for that. I see that you are not able to view the formulas which have been put in place for the computation of the standard deviation of the portfolio. I said our W's are representing the weights. We have this sign of the standard deviation. We say when it is squared is your variance of specific securities. Then we have something here which we are calling it covariance, right? Covariance. So the question is, how do I normally get my covariance? And I say, the covariance is normally have also to factor the sample size. For example, when we have the probabilities, to get the covariance of security A and B, for example, it means I have to be taking a return of A minus expected return of A, return of B minus expected return of B, then we multiply by multiply by the probabilities. Now, in case of a sample size, in case of absence of probabilities, if the probabilities are not there, it means to get the covariance of A and B, it means I just need to take the return of A minus the expected return of A, right? Then we have a return of B minus the expected return of B. Then we divide it by n minus 1 when the sample size is less than 30. When the sample size is less than 30. But when we have the sample size which is greater than 30, take your return A minus the expected return A, for example. Then you take a return of B minus the expected return of B. Then we divide by n when the sample size is greater than 30. You see how the computations are normally, the difference is when the probabilities are not there, then it means that the question is not wrongly set. We can be able to use the sample sizes, and also we get the expected, or we get the covariances. Now, the last point, or the last formula which I'm supposed to be teaching you, is all about the correlation coefficient. This is one of the formulas, by the way, to get the covariance. Now, the second formula which you can just be able to take, and you get your covariances. That is one of the formula. Then the second formula will be here with me. Right? I hope you're following. Just hoping that we are well following. So in this case, it means this was one of the formulas to get the covariance. Now, number 2 here, when you need to get the covariance of A and B, it means if, for example, these requirements are not there, it doesn't mean the question is wrong, right? Sometimes you might not be having these returns as expected, right? But now you can be able to have the correlation coefficients, and you need to check on the correlation coefficient of those. Then we multiply by the standard deviation of A and the standard deviation of B, right? This is normally called correlation coefficient. That is normally called the correlation coefficient. And we can be able to use it to get the covariances, the covariance of the two securities. Now, sometimes an examiner might be asking you to calculate this correlation coefficient of A and B, and it means you just need to take the covariance of A and B. You divide it by the standard deviation of A, multiplied by the standard deviation of B. These are the standard deviations. Those are the standard deviations. This is not what is normally called the covariance, as earlier defined. That is the covariance. I think up to that point, by the way, in terms of the portfolio theory, you don't require much of the formulas beyond that level. Those are the only formulas which you are needed, or which will require you to understand. Those ones are the ones that will require you to grasp, and then you will be able to go to the exam and sit for it. It is not something that is hard. And these questions, if you can be able to look on your past papers regarding to the portfolio and the expected returns, they are very common questions. They are very common questions. Now, I just want to go straight to our past papers. I just want to go to the past papers, right? So let me see the question which we can be able to start with. Allow me to start with a question tested on December 2023. That is at December 2023. The question should be question 2B. Someone to read, please. Let me see if there's someone here. Let me start with Judy. We can be able to hear your voice. Judy, can you read for us? Judy? Judy can't read. Juma, you can read for us? Let me see someone who can be able to read. Whitney? Nobody who can read for us?
Job Nyangaya plans to invest in two securities, Security A and Security B. The returns on each security is dependent on the state of the economy as shown below. State of the economy, probability, return on Security A, return on Security B. Required, the standard deviation for Security A and Security B, the covariance between Security A and Security B, the correlation of coefficient between Security A and Security B.
Thank you so much. For those who are able to sit for December 2023, they came across this question. And I know very well that you are able to remember the formulas, but you are unable to know how to apply them. Now, let me just show you how you can be able to apply for the formulas. I can see majority of you are being affected by challenges regarding to network. So you just need to be sitting on a good area when you're attending the class. Now, I can see number one, the examiner is asking us to calculate the standard deviation of the both securities. So when I'm going to be giving you the solution for this, right? Now I'm giving a solution for that question, and I know that you are able to open these questions from your ends, right? So when these questions are being given, the first thing that I'm supposed to be doing is to look at the formula. How do we normally get the standard deviation? For example, the standard deviation of the first security. Let me talk about security A. It means I'm going to be taking a summation of a return A minus expected return A squared, then I multiply by the probabilities, because when I was able to look on the question, or when we were able to read it, I could be able to see, based on the states of nature which have been provided, or the states of economy, the examiner was able to provide you with the probabilities. Now, the first thing is to look at how am I going to be getting the expected return of A. It means I have to be taking a return of A, then I multiply by the probability, right? The return of A multiplied by the probability. And in this case, let me talk about the summation there. So in this case, let me look on the returns which we have here, right? We have some return for A. So the first one is 27 times 0.40. That is based on the state of economy of boom. The second one is average, which is 21 plus 21. We multiply it with 0.50. Plus, the third one will be 18. 18, we multiply by 0.10, right? Someone might be using the calculator, give me the answer. The other one will be the expected return of the security B, right? For B, it will be how much? We talk about 36 times 0.40 plus, the other one will be 33. We multiply by 0.50 plus, the third one will be 31.5. We multiply by 0.10. What is the answer here? Someone who can provide the answers for both securities. What will be the security for the first one? The expected return, sorry. What is the expected return for the first one? How much? Someone? I was able to get around 23.1%. I don't know why you are fearing to speak. The other one will be 36 times 0.40 plus 33 times 0.50 plus 31.5 times 0.1. We are getting that 4.05. Anyone having the contrary answers? Is that what we are getting right now? Are we getting those expected returns in that manner?
Yes.
Thank you. So from there now, because you have the expected returns, it is very important for you to get the standard deviations. So let me start with the standard deviation of, and I will start by calculating the variances. Let me just put it in that manner. So in this case, it means I just want to take the return, as you can be able to see how they are given in a columnar form there. So the first one will be 27. The first return is 27. The expected return of ours is 23.1. squared. We multiply by the first probability of 0.40, right? The other one will be how much? The second one will be under the security one, it will be 21 minus 23.1. The expected return doesn't change for specific security squared. Then you multiply by 0.50. Then the third one and the last one will be, I could see it is 18 minus 23.1 squared. I multiply by 0.10, right? What will be our answer here? I say, let me take 27 minus 23.1 squared. Then I multiply by 0.40, getting 6.084. The other one will be 21 minus 23.1 squared. Then I multiply by 0.50, getting 2.205. Then the third one and the last one will be 18 minus 23.1 squared. I multiply it by 0.1. You are getting 2.601. 2.6001. Now, in this case, how much are you getting here? 2.205 plus 6.084. I'm getting 10.89. So to get your standard deviation of security 8 means I'm going to be taking the root of 10.89. So how much is your answer here? The root of your answer, it means you're getting something closer to 3.3. 3.3. That is the answer for the standard deviation of A. Now, when it goes to B now, you do the same, right? Now we are discussing about get the variance of B. Now, the variance of B will be the same. The first security or the first return is 36 minus 34.05 squared. We multiply by the probability of 0.40, right? The other one will be 33 minus 34.05 squared. We multiply by 0.50. Then the last one will be 31.5. I think I'm correct. That 4.05 squared. We multiply by 0.10. So what will be your answer there? You take your calculator. That's 6 minus that 4.05 squared. Then I multiply by 0.40, getting 1.52. Right? The other one will be 33 minus that 4.05 squared. Then I multiply by 0.50, getting 0.55. Then the third and the last one will be that 1.5 minus that 4.05 squared. I multiply by 0.1. I'm getting 0.605. Should be 650. Sorry. So 0.650 plus 0.551 plus 1.521. You should be getting something closer to 2.722. So what is the standard deviation of B? It means we need to take a root of 2.722. So napata ngapi, right? Getting 1.65. 1.65. That is how you normally get the standard deviations of both securities. That is how you arrive on that. Then the other thing that we can be able to check on here, the other thing is about the other requirement I can see an examiner is asking is, can you be able to get the correlation of coefficients, right? The correlation coefficient between two securities. That is the requirement number 3. So to get the correlation coefficient between A and B, it means we have to be taking our covariance of A and B. You divide it by the standard deviation of A. We multiply by the standard deviation of B. You already have the standard deviation of both securities, right? But what you don't have, it is the covariance of both securities. So to get the covariance of A and B, it means we have to be taking the summation of our return A minus the expected return A, right? Return B minus the expected return of B. Then all of these we multiply by a probability, right? Now, a white student does not go back to the question because that data is already existing in your board here. So in this case, it means the first one will be 27 minus 23.1. That is for A. Then nikienda kwa B napata, tuko na that 6 minus that 4.05. Then all of these we multiply by 0.40, right? You see, I'm just picking my data here. But in covariances, we don't square, right? Now, the other one will be 21 minus 23.1. On the other side, we have 33 minus 34.05 multiplied by 0.50. Then the third and the last one now. The third and the last one, we are going to be having 18 minus, right, 23.1, right? On the other end, we have 31.5 minus 34.05, we multiply by 0.10, right? You use your calculator so well. Correct. Now, in this case, when you are using your calculator here, I will be able to start with the first one. 27 minus 23.1. This one I'm getting 3.9. Allow me to write there. Then the other one will be 36 minus that 4.05. Then I get 1.95 for this. Then I multiply by 3.9. Then I multiply by our probability of 0.40. Getting 3.04. The other one will be 21 minus 23.1, getting negative 2.1. The other one will be 33 minus that 4.05, getting negative 1.05. Then I multiply by negative 2.1. Then I multiply by the probability of 0.5, getting 1.10. The third one will be 18 minus 23.1, right? Here we are getting negative 5.1. Then we have that 1.5 minus that 4.05. Then I multiply my answer here with negative 5.1. Then I multiply by 0.1, getting 1.30. So what is the summation of your covariance? It means I take 1.30 plus 1.10 plus 3.04, getting 5.44. Now, to get your covariance here, to get your correlation coefficient, sorry, it means I'm just going to be taking 5.44, you divide it by the standard deviation of A, we were able to get 3.3. Someone has unmuted. 1.65. What is the answer? So 3.3 multiplied by 1.65, right? So 5.44, we divide by my answer. You're going to be getting 0.999. Something closer to 1. Something closer to 1. Do you have any question? Any question? Any question? That is December 2023. That is December 2023. Any question? Do we have a question? Say something. Nani ndege because ni ako Wilson. Mary Wanjiku. Mary Wanjiku wako airport. And I can't mute her. Right, Mary, you can mute yourself. Now, there is another question which I just want to look at regarding to the same. There is a question they tested on April 2023. They did not test on August, but in April, the question is there. Mary, you can mute, please. Now, or you can read the question for us. Let me check here. There is this question, Mary, question C. Can you read for us, please? Mary? Oh, she has disappeared. Daniel, can you read our question, please?
The Maji Group portfolio comprises of Maji A shares with an expected return of 10% and a standard deviation of 20%, and Maji B shares with an expected return of 16% and a standard deviation of 40%. The correlation between Maji A shares and Maji B shares is 0.4. The portfolio is comprised of 30% Maji A and 70% Maji B. Required: the expected return of the portfolio, the standard deviation of the portfolio.
Thank you so much. That is April 2023, question 3C, right? The question number 1 is asking you, how can I be able to get the expected return of a portfolio? I can see the examiner has already broken the question down in a better way you can be able to understand. I can see they have already given you the expected returns there, because now the examiner is asking you to calculate the expected return of the portfolio, right? So if the examiner is asking you that question, number 1, what is the expected return of the portfolio? It means I'm going to be taking, for example, which securities are we dealing with? Let me just confirm once again. We are dealing with securities A and B. So in this case, it means I have to be taking the expected return of A, right? We multiply them by the expected return of A, we multiply by the weights. So let me write the formula well. So the weight of A, we multiply by the expected return of A, plus weight of B, we multiply by the expected return of B. Now, when you look on the weights, as per the sentence, the last sentence, the examiner is saying, the portfolio is normally comprised of 30% Maji A, and then 70% of Maji B. So already it means the weight of A is 0.3. We multiply it by the expected return of A, right? The expected return of A, I can see an examiner giving you 10 plus 0.7, which is obvious because the weights are supposed to be equal to 1. Then the expected return of the other one is 20. So what is our answer here? So our answer will be 0.3, we multiply by 10, plus 0.7, we multiply by 20. We are getting 17%. Are you getting 17%? Right. You're getting 17%. Let me see. We are being told, sorry. We are being told, I think there is something which is wrong here. It's not supposed to be 20 because we are being told the Maji Group portfolio comprises of Maji A shares with the expected return of 10 and standard deviation of 20, and Maji B shares with which is 16, right? This should be 16, sorry. So it means when I edit my 20 here, I put 16, we should be getting something closer to 14.2%. Very good. Then when I look on this there already, I have 2 marks. That is what the examiner wanted. He was asking you about the expected return of the portfolio. Then number 2, the examiner is asking you to get the standard deviation of the portfolio, right? The examiner is asking you to get the standard deviation of the portfolio. It means we have to be taking our long formula where we are taking the weight of A squared times the variance of A plus weight of B squared. We multiply by the variance of B, right? Then we add to the weight of A, weight of B, right? Then we multiply it by covariance of A and B. You can be able to choose where we are going to be starting from. Can I be able to start by looking on I can see the question, the examiner has already provided you with the standard deviation of both securities, and he has already given you the correlation between the A and B, which is 0.4. So in this case, it means the only thing that we don't have as per the formula, it is a covariance, and we can be able to say, to get the correlation coefficient of AB, sorry, let me just write the formula direct. To get the covariance of A and B, you can just be able to take the correlation coefficient of AB, we multiply by the standard deviation of A, then the standard deviation of B, right? When I look on the question, the examiner has already given you the correlation coefficient of the both securities, which is 0.4. Then you multiply by the standard deviation of A, which is around 20. We multiply it by the standard deviation of the other security, which is given as 40. So what is the covariance of LB? 0.4, we multiply by 20, we multiply by 40, we should be getting something closer to 320. Therefore, to get the standard deviation of the portfolio, we are going to be taking, right, the weight. Now you can be able to see the weight. We said it is 0.3 squared. We multiply by the variance. When you have the standard deviation, once you square it, it gives you the variance. For example, the standard deviation for the first one, it is 20. You square it. This is 20 for A, right? Plus the weight of B, which is 0.7 squared. We multiply it by, what is the standard deviation of the other one, which is 40 squared. We add, right? We talk about 2 times the weight of A, which is 0.3, times 0.7, right? 0.7. Then we add, we multiply by the covariance of 320. We multiply by the covariance of 320. You can be able to see this. Then you use your calculator to break down your math. You just need to take 0.3 squared times 20 squared, right? Plus 0.7 squared, plus 0.7 squared times the 40 squared, plus 2 times 0.3 times 0.7 times 320. I think we should be getting a root of 954.4. 954.4, if I take the root of that, I'm supposed to be getting the standard deviation of the portfolio, 30.89. 30 point something there. 30 point something there. Are we together? Let me just break it down. 0.3 times 20. Let me see whether I have gotten the correct answer. This should be 120. 0.7 squared times 40 squared. This should be 784. This should be 36. I'm going to say funny math, right? Now, the other one should be 2 times 0.3 times 0.7 times 320, getting 134 plus 784 plus 36. 36. No. 2 times 0.3 times 0.7 times 320. Let me confirm, please. Plus 784 plus 36. It is okay. We're supposed to be getting 30 points, 30.89. The answer is okay. The answer is okay. That is how you normally get those questions, and they are very simple. You can see how simple they are. You don't need to struggle to reach to certain points. Now, the last question which we are doing here, the last question now, which we shall be working on here, I think now we should be looking at it. These questions are very simple. You won't be able to see. There is no need to struggle so much. It should be December 2022 here, right? December 2022, we have question 2B. Juma, you can read the question, please. Juma, you can read.
The following information relates to security X and security Y returns for the year 2021. Now the probability returns, so 0.1. Okay, now what is required? Determine the expected return for security X and Y. Question 2, determine the standard deviation for each security. Question 3, determine the covariance between security X and security Y. Question 4 is determine the correlation coefficient between security X and security Y.
Thank you so much. The examiner has given you a small challenge here. He is telling you to get the return of Y, we have to be using a formula there, right? Everyone is writing something. Now, these returns which are already given there, for example, for X, he has given you the returns there, but already providing you with a formula which you're going to be using to get the some of the returns which you don't have. Now, because the first question the examiner is asking you, can you be able to get the returns of both securities? So to be able to answer these questions of yours, let me start by computing the expected return, right? The expected return of X, for example, it means I just need to take the summation of X, then I multiply by the probabilities. Correct. Now, in this case, it means already the examiner has provided you with the returns. So in that case, it means I need to be taking 20 I multiply, and is it 20, 30? 30 times 0.1 plus, the other one I can be able to see is 20 times 0.20. The third one should be 15 times 0.40. Plus the other one will be 10, right? Times 0.20. Then the last one, right? The last one should be negative 50 times 0.10, right? 0.10. Someone should be giving us the answer there. Then to get the returns, the returns already for Y. I can see we are already provided with we have 12, 10, 9. Then the other ones, for example, for the fourth one, we are being told to use the formula, which will be 6 plus 0.2. We multiply by the X, which is around 10. Then the last one will be 6 plus 0.2 times negative 50. So how much are we supposed to be getting there? So that you can get the expected return of Y. So when you take your calculator, this is very simple. This is 2. This should be 8. Then the last one will be 0.2 times negative 50. So that is 10. This should be negative 4. So to get the expected return of Y, I'm supposed just to be taking 12 times 0.10 plus the other one will be 10 times 0.20 plus 9 times 0.40 plus the other one will be 8 times 0.20 plus negative 4 times 0.10. So what is my answer here? I just need to put this data on my calculator. Plus 20 times 0.2 plus 15 times 0.4 plus 10 times 0.2 minus 50 times 0.1. We are getting something closer to 10%. Then the other one will be 12 times 0.1 plus 10 times 0.2 plus 9 times 0.4 plus 8 times 0.2 plus negative 4, for example, times 0.1, getting something closer to 8%. Correct, 8%. 8%. That is the first requirement of the question to get the expected returns. Get the expected returns, and you can be able to see we have done it with ease. Then the other one, we are being taught to get the standard deviation of each security. And you can just be able to come and you tell me, to get the standard deviation of X, we need to take the root of the summation of our return X minus the expected return of X squared, you multiply by the probability, right? So in that case, I just need to be looking on my return here, right? The returns, and then I have the expected return, which we have already gotten at the end. So the first one will be 30. Let me just put it here. That minus 10 squared, multiplied by the first probability, which is 0.10. The other one will be 20 minus 10 squared, multiplied by 0.20. The other one will be 15 minus 10 squared multiplied by 0.40. The fourth one will be 10 minus 10 squared multiplied by a probability of 0.20. Then the last one will be negative 50 minus 10 squared multiplied by 0.10. So how much is this? So this one is 20. 20 squared 400. 400 times this I get 40. Yeah, this is 10, 100. 100 by 0.2, I think it should be 20. Yeah, this is the 15 minus this one is 525. 25 times 0.4, we are getting 10. Yeah, the other one, this should be 0, right? 10 minus 10 is 0. Now, this one should be negative 60. Because it's negative 50 minus 10, which is negative 60 squared. Then I multiply by 0.1, getting 360. I think I should be getting 360, 370, 390. Right? 390 plus 40 should be 440, right? What am I talking about? 60, 70. 70 plus here, we should be getting 430. 430. So what are we looking at? The standard deviation of x, which should be equal to the root of 430. Right? So 430, what is the root of 430? 40 plus 20 plus 10 plus 360. Right? The root of answer, getting 20.74. 20.74%. The other one now we look on the security Y, right? And in this case, it will be 12. 12 minus 8 squared multiplied by the first probability, which is 0.10. The other one will be 10 minus 8 squared. We multiply by 0.20. Then the other one will be 9 minus 8 squared. We multiply by 0.40. The other one will be 8 minus 8 squared. We multiply by 0.20. Then we have negative 4 minus 8 squared. We multiply by 0.10. So what is the answer? This is 4, 16, 1.6. Right? 2, 4, 0.8. Right? 1, 0.4. 0. Then this one is 12, 144. Right? 14.4. That is how we used to do our maths. What did we go and find? Very simple. So the first one is 1.6 plus 0.8 plus 0.4 plus 14.4. We are getting 17.2. Once you get 17.2, so to get the standard deviation of y, we need to take the root of 17.2, which will be equal to what? The root of answer should be 4.15. 4.15. That is the answer. 4.15. That is how the answers you're supposed to be getting them. Now, requirement number 3 of the question, we are being told, can you be able to determine the covariance between security X and Y? And I will be able to say, let me just write the formula here. The covariance of XY, we are going to be taking the summation of a return X minus the expected return X. We come here to a return Y minus the expected return of Y, multiplied by the probability. Multiplied by the probability. So in this case, we can just be able to put it there. So the first one will be a return of X. I just need to take these figures without the powers. So for example, the first one will be 30 minus 10, right? The other one will be 20 minus 10. The other one will be 15 minus 10, 10 minus 10, then negative 50 minus 10, right? Then I come and I copy the data for the second one without the powers. So the other one will be 12 minus 8, 10 minus 8, right? 9 minus 8, 8 minus 8. Then the last one will be negative 4 minus 8. Then you multiply here with your probabilities now. And you'll be able to see how easy it is. So this one will be 0.10, 0.20, 0.40. We have 0.20. Then the last one will be 0.10, right? So how much is your answers there? Right? Can you be able to get your answers very quickly? So So when I look at it, the first one will be 20. 20 when I multiply by 4, the answer there is 4. 20 times 4 is 80. This should be 8. Yeah, 10. This is 2. 10 times 2, we get 20. 20 times 0.2, we get 4. Now, this is 15. That is 5. 5 multiplied by 1, you get 5. So 5 times 0.4, you get 2. This should be 0 because all of them are zeros. This is around 60. Negative 60, you multiply by negative 12. Then you multiply by 0.1, getting 72. So 72 plus 2 plus 12. We are getting 86. 86 there. That is the correlation, or this is the covariance in which the examiner was asking. This is the covariance. Now, the last thing which the examiner could be able to see asking you there, it is the correlation coefficient of x and y, which you said you can be able to take the covariance of x and y. You divide by the standard deviation of x multiplied by the standard deviation of y. What is the covariance of x and y? So the covariance of x and y we have is 86. You divide it by, what was your standard deviation of x, which was 20.74. We multiply it by the standard deviation of y, which is 4.15. So how much is this? So 20.74, we multiply by 4.15, getting 86. So 86 will divide by my answer. I should be getting something closer to 0.999. 0.999. That is how you normally get the question regarding to the portfolio theories. And you just need to do a lot of practice. These questions are mostly tested in your exams, and therefore you just need to go back to those past papers of yours, right? To those past papers which you have, and then look at how can you be able to sort out these problems? How can you be able to sort out the problems using the examples which I have already done for you? The examples which I've already done for you. Now, we don't have much to learn beyond that regarding to the portfolio theories, but because that is the end of it, right? That is the end of it, unless there is any question. Is there a question? Right. Mary Wanchiku, do we have any question?
No.
Is everything okay?
Yes.
Thank you so much. Now, I just want now to go through some theory. I have a theory here regarding to the ratios analysis, so that when we meet tomorrow, we just go straight away to tackle some questions regarding to the portfolio, the ratio analysis, right? Now, I know majority of you are having the notes, right? We are having some notes here. So let me just look for those notes. So when we discuss, and I think this is this topic will be the last topic for the new students. This is just our last topic, and then we embark fully on our revisions, because the revisions will be based on specific areas which I can be able to see we need to work on. But you are able to see we are doing our past paper questions all throughout. So they are the ones which normally guide our classes. Now, when you look on the financial analysis and forecasting, we are saying it normally refers to the evaluation of financial statements of the company to determine whether the firm is operating effectively or not. So the users of these financial statements will be able to include. I remember when you are looking on your financial management, when you are looking on the financial accounting, we were able to look on the areas where who are the users of the financial? And it is a question which was being tested in an exam. Who are the users of the financial statements and the financial accounting statements? And we were able to talk about shareholders, creditors, employees want to know the direction of the company. The suppliers want to know whether they are going to be paid. The government need to know whether they are going to be paid taxes, and the community need to see whether the company is growing to make sure that is going to be employing the people, is going to be employing the young ones. It can be able to absorb in terms of the corporate, corporate something. Two methods CSR, right? Corporate social responsibility. So two methods are available for evaluating the performance of the firm. One, it is the ratio analysis, which we are going to be working on. Then we have the financial forecasting. You can be able to see for those who are doing management accounting, right? Also, we are having some revisions for it. Now, for the management accountants, you can be able to see there is a preparation for cash budgets. And then we normally also have some questions the examiners are testing regarding to the percentage of the sales method. We have to be working on all of these, right? Now, that being said and done, let us look on the financial analysis first. And we have said that the ratio analysis, or the ratio refer to a relationship between two accounting figures, which are normally expressed mathematically. So one, the process of ratio analysis will be able to involve the computation of the ratios, comparison of the computed ratio with some set standards. Then number three, we have to interpret our ratios. You could be able to see every time you're going to be discussing about the analysis of the ratio, we have to be looking on the comparisons. We have to be looking on the computation. The computations is what we're going to be looking at. We're going to be doing. Then we have to do some comparisons of the computed ratios with our standards required. Then we have the interpretation. What does this ratio means? So we normally have standards of comparison. One, we have to be looking on the past ratios, and we say, these are the ratios which the ratios computed from the first financial statements of the same firm. Then we have the industry average ratios, and these are the ratios computed, which are normally computed from the financial statements of an average firms in the industry. Then we have the forecasted ratios, and these are the ratios which are computed from the forecasted pro forma financial statements of the same firm. Now, the last one we are talking about the ratios of some specific firms in the industry, especially the best performing firms. Let us look on the how do we have to express our ratios. And we're saying the ratios we can be able to express a percentage, e.g., the ratio of gross profit to sales, right? The gross profit margin can be expressed as the 15%. That is where we talk about the gross profit is 15% of our sales. Then we have as a rate, and we are saying, e.g., the ratio of inventory turnover can be expressed as 6 times. That is, on average, the company was able to convert its inventory into sales. That is one of the key things we have to be checking on. How can we be able to convert certain inventory into sales? That is the we are discussing. Now, we also talk about as a pure ratio, and that is the ratio of current assets to current liabilities can be expressed as 2:1. That is, the current assets are twice the current liabilities. Types of ratios, right? Ratios can broadly be expressed into liquidity ratios, profitability ratios, efficiency, activity turnover ratios. Gearing stock leverage ratios, and then we normally have the stock market ratios. Let us start with the first classification. We are discussing of the liquidity ratios, right? We are saying that these ratios are used to measure the firm's ability to pay current liabilities. That is, they measure the liquidity position of the firm by comparing its current assets with the current liabilities. So the higher the liquidity ratio, the better of the company is, and they are mostly expressed as pure ratios. They include, when you look on the current ratio, which is normally, it normally equates to current, we normally take the current assets, we divide by the current liabilities. But what does the current ratio means? It normally means, it normally, once you need to express, or the explanation which you have to be giving out, it is the main liquidity ratio, which shows the number of times the firm's current assets can cover its current liabilities. So the ideal current ratio is at least 2:1, right? 2:1. It means we can be able to cover our current liabilities. So that is the least we can be able to compare when it comes. That is the standard ratio which is already expressed there. We normally have the quick ratio, and when you look on the quick ratio, which is normally also called the acid test ratio, we normally take the current assets minus inventory. We divide it by the current liabilities, and it is the stricter measure of the firm's ability to pay current liabilities using its current level of quick assets. That is that this ratio is basically, it normally look on the current assets, which can be quickly or easily be converted into cash. And that is where we are subtracting inventory there, because the inventory is not considered as a quick asset, right? It is not a quick asset which you can be able to convert or easily be converted into cash. We have the cash ratio. We have the cash in hand at bank divided by the current liabilities. It is an extremely strict measure of the firm's ability to pay its current liabilities using its current level of cash and cash equivalents. Internal measures here, we are saying we have to be taking current assets. Then we normally divide by the daily operating costs. When you look on the daily operating cost, we normally take the annual operating cost of the company. We divide by the number of days provided by the examiner. Sometimes it might be 365. Sometimes they might be talking about 360. It depends with the figure or the value, which is the number of days provided in the question. And it normally shows the number of times the firm's operating expenses can be covered by its current assets on daily basis. The second type of ratio, we are discussing about profitability ratios, and most of them are normally converted into percentages. They are normally expressed into percentage, and they are the profitability ratio, the more the profitable the firm is. So for example, when you look on the return on the capital employed, what is the return of it? We normally look on the operating profit, which is already generated by which the organization is generating. We divide by the capital which we were able to employ, we are able to inject in the business. Then we express it as a percentage by multiplied by 100%. So where the capital employed is the total long-term funds, which are basically the common equity capital, preference share capital, and the long-term debts. So when you look on the equity, we normally take the ordinary share capital plus reserves. So when you look on our reserves, they normally comprises of the capital reserves, which are basically the share premiums. And then we normally have the revenue reserves, which we normally call the retained earnings. And as per the knowledge that you have regarding to the retained earnings, is how you could be able to see when you are computing the WACC, WMCC, it is very crucial for you to understand that the retained earnings normally form part of equity. Now, it is the main profitability ratio which measures the firm's ability to generate the profit out of its current investment in the long-term funds. Now, we normally have the return on investment. I know today when you are doing your investment there, you are asking yourself, what will be the return on investment? For example, in money markets, I could be able to see most of the people are shifting their attention in the money market. And in this regard, it means if you are going to be investing as a certain money, they have to be telling you the return of the investment is going to be a proportion of 14%, 17%, and so on and so forth. So it basically shows the firm's ability to generate profit out of each investment, right? By taking the profit after tax, you divide by the total assets, and then you express the percentage. Now, what is the return of the total shareholders fund, right? The shareholders funds, we are going to be taking the profit after tax, we divide it by the preference share capital plus equity, we multiply by 100. And it basically measures the firm's ability to generate profits out of each investment made in shareholders' funds. We normally have the return of equity, the return on equity, which we normally call it ROE. We normally take the profit after tax, we divide by the profit after tax and the preferred dividends, we divide by equity, then we express the percentage. And based on its explanation, it normally compare the profit attributable to ordinary shareholders with the common equity capital as a measure of the firm's ability to sustain the current level of profit using the common shareholders funds. The other types of profitability, we have the probability. We normally have operating expense ratios. Basically, we can be able to get the operating expense by taking the cost of sales. You had the operating cost, then you divide by the sales. Because it is going to be measuring the firm's ability to minimize its operating expenses while still generating a given amount of sales revenue. Now, we look on the gross profit margin, which you normally take the gross profit, you divide by the sales, you multiply by 100. We normally have the gross profit markup. We normally take the gross profit to divide by the cost of sales. The operating margin, we normally take the operating profit to divide by sales. We normally have the net profit markup. And when you're going to be doing the examine with the questions, I'm just going to be showing you the difference between the margins and the markups. Number 3, we normally have the efficiency activity turnover ratios. And these are the ratios which are going to measure the degree of efficiency in a firm when managing its current assets and the current liabilities. So they are basically used to measure the firm's ability to effectively manage the investment in assets and liabilities. So for example, when you look on the inventory turnover, we have to be checking the rate of stock by taking the cost of sales, you divide by the average inventory. And in this case, we have to be talking about our answer should be expressed in times. And when you look on the average inventory, it means you just need to take the opening plus the closing divided by 2. And basically, it normally measures on average the frequency by which the firm was able to convert its inventory into sales. That is, the number of times the firm was able to buy and sell its inventory during the year. So the higher the turnover, the more the efficient the firm will be. Now, when you look on the inventory holding period, and these are basically depending on the number of days, and we are saying that we normally take the number of days. It's not important, or it is not a must. The figure is given in 365, as I have earlier noted. So we need just to be taking 365 divided by the inventory turnover. And when you look on the formulas of inventory turnover up here, we can just be able to use it. So the inventory turnover, we were able to say, you can just be able to take the average inventory divided by the cost of sales by making something here. The inventory turnover, you make something here, the subject of the formula. I will be able to show you that as we do our relevant questions. And it basically shows on the average the duration taken by the firm to hold inventory in stores before selling it to customers. So the lower the duration, the more efficient the firm is. We normally have some debtors turnover. Debtors are the same like receivables, and these are the annual credit set divided by the average debtors. And it basically measures the number of times that the firm's credit customers were able to pay their debts during the year. The higher the turnover, the more efficient the firm is. So when you look on the receivables period, the average collection period, we normally take 365, we divide by the receivables turnover, expressed in days. Or we can be able to make something there, the subject of the formula, then you reciprocate. You're going to just to be getting coming up with this formula, which I will be able to show you how you need to apply it in questions. So it basically shows the credit period offered to the firm's customers. So the shorter the period, by the way, because the more you administer this credit, and you can be able to see the more you are going to be administering the credit to customers, the longer the period it is going to be affecting the organization in terms of the cash flow. So the shorter the period, maybe the 2 weeks, 1 week, is more important due to there is an overflow of the cash flow within the organization. So when you look on the payables turnover, these we normally, when you talk about the payables, these are the credit purchases. These are the people who are going to be giving you items of credit. And basically, we are going to be dividing into the average creditors. And it normally measures on average the frequency by which the firm pays its suppliers. Sometimes we might be asking yourself, why are we coming with the 45 days? Why are we coming up with a certain certain days for the payment of that? So the longer the duration, the better of the firm is. So what about the payables period? Stroke the average payment period. In this case, we normally take 365, we divide by the payables turnover, or we take 365, we multiply by the average creditors, we divide by the annual credit purchases, and it shows the credit period offered to the firm by the suppliers. So the lower the period, the better of the firm is. What about the total asset turnover? You need to take the sales, you divide by the total assets. Your answer should be expressed in times. And it normally shows the number of times that the current level of sales can cover its investment in total assets. So they are the beta. We have the fixed asset turnover. So we have the sales divided by the fixed assets, right? We also have the capital employed turnover. We take sales over the capital employed. Equity turnover, we take our sales to divide by the equity expressed in times. What about the gearing ratios, right? These are used, not soon, but it should be used to measure the financial stock gearing level leverage risk. That is the risk associated with the use of the debt finance in the capital structure. They measure the extent to which the firm is financed by the owners of equity, as well as borrowed funds. The other ratio, the higher the risk. They normally include the debt ratio. This one, we normally talk the debt to asset ratio. The total liabilities to the total assets. That is the debt ratios. And already under the explanation, we are supposed to say, they normally compare the firm's ability with its total assets as a measure of how safe the firm is with regard to the payment of debts, right? What about the gearing ratios? We have the long-term debt plus the preference share capital. You divide by the capital employed, which normally comprise of the long-term debt, preference share capital, and equity. We have the debt to equity ratio, where we normally take the long-term debt to divide by the equity multiplied by 100%. We have the equity multiplier, which is normally expressed by times. And it basically shows the firm's ability to recover its investment in equity from its current level of total assets. The higher the ratio, the better of the firm is. Interest cover, which we normally call it the fixed charge cover, time and rates. You're going to be taking your EBIT, the operating profit, to divide by the interest, and it is basically going to be showing the number of times that the firm can pay its interest or financial cost out of the current level of operating profit, and the higher, the better. Then when you're going to, once we do the illustrations of the types of the ratios, then we are good now to be elaborating more about the stock market, which we are calling it investor ratios, as we continue to check on the cash operating cycles and so on and so forth. But the first stage, which we shall be able to tackle tomorrow, is more of the ratios. So let us just repeat the same ratios in our day tomorrow. And then it is very key for us to, it is very important for us to understand that once we deal with the ratios and we understand them, then it will be easier for us to go to the stock market, investor ratios, capital, cash operating cycles on our way to the completion and understanding more about the ratios. It is a bit wide, but it should be enjoyable because you have to cram now. This one you have to cram. There is no any aspect here. You'll be able to see what you are going to be understanding should be the questions. But once you understand the questions, from there we have to be looking on which formulas are we supposed to be using, and the criteria which you can be able to use to apply the available formulas to tackle the ratio analysis. Any question? Any question?